Welcome to Market Brief After Hours. Today's trading session was an absolute roller coaster. We saw sharp intraday swings across global markets, primarily driven by escalating tensions in the Persian Gulf and a massive, sudden surge in oil prices.
It truly was a turbulent day on the trading floor. Investors are clearly unsettled right now. The renewed military rhetoric from the United States regarding Iran has everyone questioning the duration and the potential intensity of a wider conflict. When you combine that geopolitical anxiety with fears of prolonged shipping disruptions through the Strait of Hormuz, which is a critical choke point for global energy transit, it's no surprise that energy markets completely took over the narrative today.
Let's break down exactly how the major U.S. indices handled that pressure. The Dow Jones Industrial Average slipped by 0.13%, dropping 61 points to close at 46,505. But looking at the closing number alone hides a massive 600-point swing that happened intraday.
Exactly. The early losses were severe, directly driven by that initial oil shock. We did see a partial reversal later in the afternoon, when reports hinted at potential monitoring measures being set up in the Strait of Hormuz. That calmed nerves just a little bit, allowing equities to climb off their daily lows. But make no mistake, market sentiment remains incredibly fragile.
The S&P 500 actually managed to fight its way back to green, rising 0.11% to close at 6,583. That is quite the recovery, considering it was down 1.5% at its lowest point today.
That recovery shows a very cautious rotation back into equities. Even with mounting inflation concerns tied to those elevated oil prices, buyers eventually stepped in. There's a tug-of-war happening right now between geopolitical fear and investors looking to buy the dip.
And the Nasdaq Composite followed a similar path, advancing 0.18% to finish at 21,879. That's a solid bounce back from a steep 2.2% drop earlier in the session.
It highlights the continued resilience of growth in tech stocks. Even when broader market volatility spikes and macro fears take over, there is still an underlying appetite for tech equities.
Moving overseas, European markets closed mixed amid all this heightened uncertainty. The pan-European STOXX 600 ended down 0.3%.
The country-specific performance across Europe was quite uneven. In the UK, the FTSE 100 actually rose 0.63% to close at 10,431. But looking at the rest of the continent, the picture was much redder. Germany's DAX fell 0.56% to 23,168, and France's CAC 40 declined 0.43% to 7,947. We also saw Italy's FTSE MIB slip 0.2% to 45,625, and Switzerland's SMI edged down slightly by 0.07% to 12,982.
We also had a flurry of mixed economic data out of those European countries to digest alongside the market moves.
We did. France saw its budget deficit narrow to 32.1 billion euros, and Italy reported a 1.6% increase in retail sales, which are positive signals. On the flip side, Switzerland's inflation ticked up 0.3% year-on-year, and Portugal's industrial production took a very sharp hit, dropping 4.4%. It paints a picture of a fragmented European economy.
Asia-Pacific markets didn't fare as well, taking a much harder hit from the oil shock and the geopolitical headlines.
It was a broad slide across the board in Asia. South Korea's KOSPI plunged 4.47% to 5,234, and the KOSDAQ dropped 5.36%. Japan's Nikkei 225 fell 2.38% to 52,463, while the TOPIX lost 1.61%. The escalation signals from the U.S. really damaged risk appetite in the region. Even Australia's ASX 200 declined 1.06%, despite stronger trade data. China's CSI 300 dropped 1.04%, and Hong Kong's Hang Seng fell around 1%. India was the rare bright spot, with the Sensex rising 0.25% and the Nifty 50 gaining 0.15%.
Speaking of that oil shock, the numbers are staggering. West Texas Intermediate crude jumped an incredible 11.41% to $111.54. That is the highest level we've seen since June 2022.
And Brent crude wasn't far behind, rising 7.78% to $109.03. The fear of tanker traffic being disrupted following warnings of intensified military action is pricing a massive risk premium into energy right now.
That risk premium is bleeding into the bond market, too. The 10-year Treasury yield increased by more than 2 basis points to 4.332%.
We also saw the 2-year yield rise to 3.813%, and the 30-year yield climb to 4.915%. This is a direct reflection of heightened inflation expectations. If energy prices stay high, inflation stays sticky, and the bond market is reacting to that reality.
Interestingly, U.S. weekly jobless claims fell below expectations. New applications dropped by 9,000 to 202,000.
Economists had forecast 212,000, so this shows the low-hire, low-fire dynamic is still very much intact. Companies aren't necessarily hiring aggressively, but they are holding on to the staff they have. However, analysts are warning that the Middle East conflict and the impact of aggressive import tariffs are significant downside risks for future payroll growth.
We even saw cryptocurrencies retreat today. Bitcoin fell 1.7% to $67,029, though trading volume actually rose 5.5% to $39.7 billion.
Crypto is highly sensitive to shifts in global risk sentiment. When equities drop on geopolitical fears, digital assets usually follow. Ethereum dropped 3.7% to $2,063. We saw broader weakness across altcoins too. Solana shed 5.6%, Binance Coin fell 5.1%, Cardano lost 3.9%, XRP was down 3.2%, and Dogecoin declined 2.8%.
We are going to take a quick break right here. When we come back, we'll dive into the Forex markets, look at the technical moving averages, and break down today's biggest individual market movers. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the broader indices and commodities. Now let's get into the foreign exchange markets and look at the technical setups. The euro against the US dollar extended its losses today, closing at 1.1536, which is down 0.46%.
The technical picture there is quite bearish. The pair finished at the session low, reinforcing sustained downside pressure. It remains firmly below all its key moving averages. The 50-day simple moving average is up at 1.1710, the 100-day is at 1.1687, and the 200-day is at 1.1676.
So all three of those averages are acting as heavy overhead resistance right now.
Precisely. The price action shows a clear sequence of lower highs and lower lows since mid-February, which confirms a well-established bearish trend. If it breaks below the current support at 1.1536, the path opens up toward 1.1480. It would take a sustained move back above 1.1609 just to stabilize the near-term momentum.
The British pound against the dollar is looking quite similar. GBP USD settled at 1.3224, down 0.62%.
Again, closing at the session low. It is trading well below its 50-day SMA of 1.3484, its 100-day SMA at 1.3415, and its 200-day SMA at 1.3426. The broader structure is negative. Immediate resistance is at 1.3224 and then 1.3320, with support down near 1.3050. Continued weakness below current levels will just reinforce that bearish bias.
On the flip side, the US dollar against the Japanese yen is climbing. USD JPY closed at 159.67, up 0.56%.
This pair is maintaining a very strong upward trajectory. Unlike the euro and the pound, the dollar-yen is trading comfortably above its key moving averages. The 50-day SMA is at 156.68, the 100-day at 156.58, and the 200-day is way down at 152.65. All of those averages are trending higher.
It seems to be targeting that psychological 160.00 level.
It is. The broader trend is firmly bullish with higher highs and higher lows. Support is located at 158.54. If it can sustain strength here, a test of 160.00 is highly likely.
Let's look at precious metals. Gold pulled back sharply, closing at $4,673, down 1.80%.
Gold failed to hold its highs today, rejecting levels near $4,800. It's now sitting below its 50-day SMA of $4,949. However, it is still above the 100-day SMA at $4,633 and well above the 200-day SMA at $4,120. So the long-term trend is still supported by those rising long-term averages, but we are seeing a medium-term correction following the earlier rally. That's the correct read right now. If it breaks below support at $4,554, that signals deeper downside risk, but holding above support could allow for some consolidation.
Silver took an even harder hit, closing at $72.68, down 3.15%.
Strong selling pressure there.
Silver is now below both its 50-day SMA at $83.23 and its 100-day SMA at $74.68. It's only holding above the 200-day SMA, which is down at $58.26. It has definitely shifted into a corrective phase, with lower highs forming since the February peak.
Let's pivot to individual stocks and the big market movers today. SBA Communications was a massive standout, jumping more than 18%.
That surge was driven by reports that the company is exploring strategic options, which includes a potential sale. Whenever there is preliminary takeover interest, you usually see a massive spike like this as investors price in an acquisition premium.
Global Star also had a huge day, rallying over 13%.
This one is tied to Amazon. There are reports that Amazon is in discussions to acquire the satellite communications company. Naturally, being tied to a tech giant like Amazon sent investor optimism through the roof.
It wasn't all positive news, though. Alto Neuroscience dropped more than 7%.
A tough day for them. Their Phase 2 trial for Alto 101 failed to achieve statistical significance compared to a placebo. This was a trial for treating cognitive impairment linked to schizophrenia, so a clinical failure of that magnitude understandably triggered a sharp sell-off.
Then there is Tesla. The stock slid more than 5% after reporting first-quarter vehicle deliveries.
They delivered 358,023 vehicles. That missed Wall Street expectations of 372,160. A miss of that size immediately raises red flags about consumer demand.
We also saw a slide in alternative asset managers. Ares Management fell more than 3%, Apollo Global Management dropped over 2%, and both Blue Owl Capital and Blackstone declined more than 1%.
This sector-wide drop was triggered by Blue Owl. They announced they would limit redemptions from 2 of their private credit funds because of rising withdrawal requests. Whenever a fund limits redemptions, it spooks the market. It raises liquidity concerns, and that fear quickly spread to other major asset managers today.
As we wrap up, it's worth noting that this is a shortened trading week ahead of the Good Friday holiday. It's certainly a complex environment to navigate right now. We will leave it there for today. If you find this useful, please follow Market Brief after hours.